Good afternoon, everybody, and welcome to Cushman and Wakefield's Capital Markets Overview webinar. My name's Anna Town, and I look after business development services across Asia Pacific. I'm based in Sydney today, and we've got a great lineup of speakers for you this afternoon. So, as we always do, we're going to take a bit of a whistle-stop tour of Asia Pacific capital markets and look at some of the key investment trends that have been going on this quarter and year to date, what investors are focusing on, what the transaction volumes look like, and some of those underlying property market fundamentals that are driving those investment decisions. So we're going to hear that so far this year, we've seen a concentration of investment activity in the Japanese, Chinese, and South Korean commercial real estate markets. And in fact, these three markets, South Korea and China, have combined to make up 2/3 of total investment activity in Asia Pacific in the 9 months to September 2020, which actually is a record high for these three markets. There's often activity and interest in these three markets, but this is the highest transaction activity on record. We're going to hear that two sectors, no surprises, industrial and multifamily, saw investment volume significantly up in the 9 months to September 2020 compared to the same period last year. Industrial up by 15%, multifamily by 76%, but Catherine will go into more detail on that. And we're actually going to publish two reports on global investment trends around these two sectors, on industrial and multifamily, in the upcoming months. So keep an eye out on that. It'll have perspectives from Cushman and Wakefield experts right around the world on these two exciting asset classes. So if we go to the next slide, I'll introduce our speakers that we have today. And of course, we have Catherine Chen kicking us off as usual, and she's going to give us the tour around the Asia Pacific capital markets activity. Catherine's the Director of Research in our Greater China business. We're then going to be joined by Timothy Gregson, who's based in Tokyo, and he's head of our cross-border transactions team in Japan. And Timothy's going to take us through a deep dive into the Japanese commercial real estate markets. He'll take us through all the asset classes from hospitality to retail, industrial to office. And, you know, I think we all are probably fairly familiar that Japan is seeing some of the lowest vacancy rates in both office and industrial real estate at the moment. And Timothy's going to share his view on where he thinks these are going to go in the future, given the supply pipeline that we have in play. Then we've got lots of time left for our panel. We've got a great panel lined up today. Our panel will be made up of Dennis Yeo, who's the head of our investor services business in Asia Pacific. Dennis is based in Singapore. Gordon Marsden, who's the regional director of our Asia Pacific capital markets business based in Hong Kong, and of course Timothy. And I know they're very much looking forward to your questions. They're very well qualified between them to answer anything on cross-border capital trends in Asia Pacific as well as globally, and you know, the future performance or outlook for the Japanese capital markets. So please get your questions ready. You can pop them into the question mark box in the top right hand side of your screen, and we'll attempt to get through as many of those as possible. But with that, I will hand over to Catherine to kick off the presentation.
Thank you, Anna. Let's first take a look at the three key investment themes in Asia Pacific this year. The first is flight to safety. As we are now facing a prolonged global pandemic, most investors are aiming for safe haven assets to minimize risk and uncertainties. That's why we're seeing increasing investment allocation in mature markets such as Tokyo, Seoul, and China's tier 1 cities, where liquidity is high and the pandemic is relatively under control. Of course, the flight to safety phenomenon also includes some back-at-home purchases, where domestic investors feel safer to make an investment at their home country with increasing border control during the pandemic time. The second is flight to quality, which tends to follow a similar trend as flight to safety, but refers to the quality of the target asset. Inside the gateway cities, investors tend to prefer high quality and stabilized assets in core locations. For instance, within the office sector, the number of properties being sold at CBD locations were 35% more than that in the suburbs so far this year. While location is not a single determinant of the quality of an asset, with future supply being more concentrated in non-core locations, being at a city center usually means facing less competition from the incoming supply. The third and probably the most prominent change of investor behavior during the pandemic is flight to necessity. One of the major impacts of the COVID outbreak on the real estate market is making people to reevaluate what is absolutely needed when facing lockdowns, when people were unable to go to an office or retail facility. And this has led to increasing investment in the necessity sectors such as the multifamily, logistics, and data centers. Next, let's take a look at the total investment volume in Asia Pacific so far this year. Please note that this chart excludes investment in the land market, which total over 450 billion USD over the first 3 quarters and seems to be less affected by the pandemic, as the transaction volume was down by only 13% year-on-year. In comparison, investment in the commercial property sector witnessed a drop of close to 30% over the first 3 quarters. Nonetheless, core markets such as Japan and South Korea, as aforementioned, remain quite active, with investment volume almost in line with the same level last year. In contrast, transaction activity significantly dropped in Australia, Hong Kong, and Singapore for various reasons such as the ability to control the pandemic and the availability of tradable assets. In addition, we found that capital is more concentrated in the large gateway cities, with Japan being Tokyo, South Korea being Seoul, and mainland China being Beijing and Shanghai. Overall, we expect the total transaction volume in Asia Pacific to drop by around 30% this year, followed by a rebound of approximately 25% in 2021. For top investment destinations, Seoul is the most active market this year, both in Q3 and year to date. Seoul's office market is especially robust, with a record $5 billion USD worth of offices being traded in a single quarter. Several factors contributed to the soaring office investment in Seoul. One is increasing domestic capital flowing into the core office market, given the tight supply and growing office rentals. In Q3, both the CBD and GBD submarkets in Seoul have registered record-breaking office deals as competition for core office assets intensifies. On the supply side, banks and financial companies in South Korea are also setting off offices at the perceived peaking prices to improve liquidity as required by Basel III. Japanese and Chinese cities, on the other hand, started the year strong but tapered off in Q3 as the global pandemic drags on. The top 5 markets, Seoul, Tokyo, Hong Kong, Shanghai, and Beijing, together made up about half of the total transaction volume in Asia Pacific so far this year. And this represents an increase from the share of only 40% last year, an indicator of investors shifting to core markets. By sector, industrial is now the second most invested property class, accounting for 21% of total investment volume year to date, up from 15% last year. Share of investment into apartment also doubled this year, accounting for 8%. By nominal value, total investment into the industrial and apartment sectors witnessed an increase of 15% and 76% respectively for the first 3 quarters. This further approves the third trend, the trend of flight to necessity, that with increasing challenges in managing office and retail assets in the COVID era, investors have identified more resilience in the multifamily and industrial sectors. Vietnam has also been benefiting from the shift of manufacturing facilities from mainland China and recorded a number of large industrial deals from international investors in Q3. Nonetheless, office is still the #1 most invested asset class by consideration, accounting for nearly half of the total investment volume. In contrast, Hotel and retail sectors, by no surprise, saw investment significantly down this year, although some markets, such as South Korea, continue to see robust retail investment as the year-to-date transaction volume already exceeded last year's level. For cross-border investment, surprisingly, despite the COVID outbreak, capital outside APAC represents a larger share of investment than capital within APAC this year, accounting for 60% of the total cross-border investment over the first 3 quarters. This is in fact due to the concentration of cross-border investment by large global institutional investors such as Blackstone and AEW, as the US tops the list for cross-border capital source. In addition, we saw increasing participation of JVs and partnerships by US investors, especially for deals in China. On the other hand, Asia-Pacific investors, such as the Chinese and South Korean investors, have generally focused on their home markets this year. With the recent signing of RCEP, we expect investment within the Asia-Pacific region, especially among the 15 RCEP countries, will become more active once the pandemic eases out. For top investment destinations, Japan emerged as the #1 most popular cross-border investment destination this year, although this was driven by a few large deals led by the US investors, such as Blackstone's purchase of Anbang portfolio earlier in the year. India has also received increasing interest from global investors. Although India is ranked lower on the list for transactions as of Q3, it has become increasingly favored by international investors led by Blackstone and included Goldman Sachs, Wakefield, Mapletree, and Ascendas. Going forward with the signing of RCEP, we expect the Asian countries will likely receive more capital investment from China, Japan, South Korea, and Australia. On investment strategies, the table here summarizes the key investment themes and strategies among the various fund categories. On the core, we would recommend urban logistics, late cycle offices, and the no cycle sectors such as multifamily and data centers. On the core plus and value add, we think from a medium to long-term perspective, large mixed-use projects in gateway cities still have the upside potential on the back of urbanization, population growth, and also a rebound in tourism once the pandemic is over. Repositioning opportunities in core locations, especially in markets where there's a very limited land supply, acquiring an underperforming asset for upgrading or redevelopment can potentially yield very attractive returns if the new owner has very strong asset management capabilities. In addition, high-tech and business parks in the major tech cities, as driven by accelerated growth in the tech industries post-pandemic, as well as increasing decentralization for cost control, present very attractive investment opportunities. For time reasons, I won't go into too much detail, but please feel free to raise questions during the Q&A session or contact us directly if you are interested in knowing more about the investment opportunities. The next few slides summarize the key office leasing trends for investors who are interested in office investments. Among the 40 key office markets we track across Asia Pacific, Seoul tops the list for office absorption in Q3 with the strongest Q-on-Q rental growth. So no wonder Seoul's office market is so heated at the moment. Other markets like Tokyo also provide very good investment prospects with low vacancy rates and stable rentals. In terms of future supply pipeline, we rank the markets by the ratio of future supply to its existing office stock. Australia and North Asia, which is comprised of Tokyo and Seoul, have the lowest pipeline to stock ratios, meaning that once the pandemic is over, these markets are more likely to see rentals to rebound to pre-COVID levels or even see some growth in the medium term as they face less pressure on the supply side. In terms of office demand, we found that the tech cities such as Tokyo, Bengaluru, Seoul, and Shenzhen had the best performance this year. Comparing to 2019, North Asia saw a notable increase in the share of office demand thanks to the high concentration of TMT tenants in Tokyo and Seoul. In addition, new developments in these two cities typically have very high pre-leasing rates, sometimes as high as 90% or above, and this year's strong absorption also reflects some of the pre-leasing deals that were signed last year, but occupancy took place this year. The final two slides demonstrate long-term economic growth outlook in the various APAC markets over the next decade. According to Moody's Analytics, most APAC regions except mainland China and Vietnam will likely see GDP growth dip into negative territory this year. However, the red bars, which represent average GDP growth over the next 10 years, show that markets such as mainland China, Vietnam, Philippines, and India all have very strong growth prospects over the longer term. For office employment, Greater China will likely account for over half of the new office jobs being created over the next decade as a result of industry upgrading in mainland China. If you are interested in knowing more about the global office market outlook, we have recently published a series of forward-looking reports such as Global Office Impact Study and Recovery Timing, Purpose of Place, and the Optimal Office Ecosystem Models, all available for download on our website. And with that, I will hand over to Tim to take us through the Tokyo market. Over to you, Tim.
Thanks very much, Catherine. So just jumping right into it, on the macro front, Shinzo Abe, who was Japan's longest-serving prime minister, resigned last August, signaling the end of an era. And Yoshihide Suga took over the top spot in September, and he's largely expected to pursue the same overarching goals of Abenomics. Several key ministers maintain their positions as well, indicating continued political stability in Japan for the moment. However, there were some new commitments that I think are worthy of note. For example, new commitments made to the digitization of Japan, including a reduced reliance on the archaic Hanko system, and which will result in a subsequent reduction in the stacks of paperwork that keep piling up on people's desks, as well as we see that this digital commitment, as well as continued implementation of teleworking, will translate into a reduced demand for office space. Additionally, the reduction of greenhouse gas emissions to zero also, we think, has implications for property owners, as approximately 40% of all greenhouse gas emissions are generated by building materials and operations. So real estate owners will increasingly be required to make informed decisions about property lifecycle costs. That said, for the moment, all eyes are on the pandemic and the economic recovery from it. Now, the good news is that we are seeing positive signs at the moment. So GDP results were not great for the first 2 quarters of the year, but we were expecting that. We also expected to see a bounce back in Q3, and it looks like that is coming to fruition as the Japanese government reported Q3 figures this week, and the results indicated the strongest quarter in 52 years. So Japan's GDP grew at 21.4% versus what economists had predicted, which was an 18.9% growth. And this news, combined with positive vaccine news from Pfizer and from Moderna, have sent the Nikkei 225 index to its highest point since the bubble era. Still, despite this, many analysts are cautioning against unbridled optimism as rising virus cases at home and abroad continue to rise. So, moving on to investment transaction volume. Compared with other global markets, as we've just heard, overall transaction volume is faring quite well in Japan. Majority was driven by large transactions inked at the earlier part of the year. So year to date, 2020 figures are only down about 19.4% from 2019 figures. And as you can see here on the left-hand side, Q1 and Q2 figures came in pretty much on par with last year. And Q3 figures are showing a market decline, but I must note that due to the opaque nature of the Japanese market, our Q3 figures are expected to trend upwards as new data comes available in the future. And investor appetite has not waned and competition for quality assets remains, especially in the hotly contested sectors of residential and logistics. Our asset management group has been very active in the logistics space and managed to complete several large transactions despite the pandemic. The majority of funds targeting Japan are in the opportunistic and value add space, as you can see here. So this suggests that there will be a fair amount of competition and may price some players out of the market. So it will require investors to pursue creative and off-market opportunities to get capital allocated. So moving on to some more sector-specific discussion. On the back of a relaxed travel visa program and the Tokyo Olympic Games, up until early this year, the hotel sector had been viewed as the darling investment class for Japan. Now, it goes without saying that the pandemic has hit the hospitality sector particularly hard. And as you can see here, inbound tourism has all disappeared. Now, the saving grace for Japan's hotel operators has been the domestic business travel and what the government has called the Go-To campaign. Now, this incentive-laden Go-To campaign launched at the end of July, originally excluded Tokyo, but it expanded to include the Tokyo area from October. And what this campaign does is it provides heavy discounts on the hotel costs, as well as provides those that stay at the hotels with incentives to spend money in the local area. So I think that's really helped the hotel operators. And as you can see here, we are seeing, a little bit of an uptick in room occupancy ratio. Now, it looks like for the most part the worst is over, but vaccines are still not going to be available until February at the earliest. Now, despite all these challenges, there has been very little visible distress in the market compared with elsewhere in the world. So we still aren't seeing a large amount of distressed hotel properties hitting the market. Now, as with elsewhere in the world, the pandemic has accelerated the shift to e-commerce in Japan as well. Now, retail sales in particular, general merchandise and apparel, have seen 2 straight seasons of sharp decline after years of subpar performance. Apparel firms have been hit particularly hard by the pandemic, and most firms are instigating cost-cutting measures such as reducing headcount and shuttering of stores. Drugs and toiletries remain positive, as for the most part these goods are essential, so those are being bought. Notably, for the first time in years through the pandemic, we've seen high street rents in Ginza and Shinjuku pull back from previous peaks, as these locations have been highly impacted by the decline in both tourists and domestic shoppers. And these pullback in rents are likely to spread to other areas, increasing the difficulty for investors to underwrite new investments in the retail space. The flip side of the physical retail space is that demand for warehouse space has increased, resulting in the lowest vacancy rate that we have on record, and for warehouses in the Tokyo area. And the sources of this demand are twofold. One is definitely the positive knock-on effect from e-commerce, and the other is due to kind of a less positive issue, which is less product moving off the shelves, for example, in the apparel sector. So rents we track in all locations but one have exhibited rental growth throughout the pandemic, and the one area that hasn't shown growth was more due to a statistical anomaly rather than poor fundamentals. We've also seen supply spikes in Q4 2019 and Q2 2020 absorbed well by the market, and we don't expect to see much change leading into next year. So, as was mentioned by both Anna and Catherine, this sector is garnering a great deal of attention from both investors globally, and locally. Meaning competition is very intense for prime assets, and we think this trend will only continue. We foresee the logistics sector to continue to benefit from the trends in e-commerce, and we see opportunities in the development of new facilities, the modernization of existing facilities, and we also see logistics being a home for core capital once these facilities are stabilized. And I would like to highlight that our asset management team here in Japan has developed a core competency in this asset class over the past few years. And again, despite the global pandemic, we have secured and closed on several marquee transactions during this period. To touch on the office sector, all 13 new grade A office properties scheduled for completion in 2020 in the Tokyo area have been completed already, and 10 of these have completed with 100% occupancy as a result of strong pre-leasing activities. Heading into the pandemic, the Tokyo office market was in a very good position in terms of vacancy rate, and due to very low vacancies, Tokyo had been a landlord-centric market over the past several years. But this is quickly changing as COVID and teleworking-related space reductions, secondary vacancies, and a new supply wave starting in 2023 are all headwinds. For these reasons, we are forecasting an increase in the vacancy rate in Tokyo. Essentially, we think it will double over the next 2 to 3 years in even our most optimistic scenarios. So we're also forecasting downward pressure on rents over the course of the next few years. So for investors, the implications of our forecast are that it's more important than ever to stay close to tenants, understand their needs, and actively engage in tenant retention strategies. So in conclusion, political stability created under Abe's tenure is expected to continue under Suga. Transaction activity remains solid compared with global peers, and capital continues to target Japan as an attractive destination. As travel restrictions ease, so too will the pain in the hospitality sector, and this should have a positive knock-on effect on the retail sector, but the long-term outlook for this sector is more clouded. Trends in the work from home and the increase in new supply create headwinds for the office sector that will take years to unfold. From our research, it is clear that remote work is complementary to in-office work when used to a certain extent, but when used in excess of 2.5 days, the detrimental effects on workplace relationships and innovation have become apparent. As such, while we see the role of the office changing, we do not see the office losing its role as a place of importance, and investment opportunities will become much more nuanced. But as with turbulent times of the past, opportunities will be available for the creative investor. Thank you very much.
Thank you, Tim. Now it's our Q&A time. Please feel free to submit your questions in the question box on your right-hand side, and we'll try our best to answer them during this webinar or by email afterwards if there's not enough time. The first question I see here is on fundraising activity, and I'd like to ask Gordon, as I know you work very closely with fund managers and PE firms, what's your impression on liquidity in the APAC region? What types of funds are being most raised? Is it core, value add, or opportunistic?
Thank you for that, Catherine. I mean, you sort of said it yourself at the top of the presentation, liquidity is good. But I'll add a but to that. So liquidity is good, but I think increasingly concentrated. And concentrated, I guess, has sort of many meanings. You touched on it a little bit in your opening slide, this sort of focus on sort of safety, on quality, and also on necessity real estate. Looking at it from a slightly different sort of direction, we sort of see figures that say that into the private equity closed-ended real estate vehicles, we're expecting to see by the year end about $130 billion into that globally, so kind of 15 to 25% down on the last 5 years. Absolutely sure, confident that that is going to bounce back. But what I'm sort of less sure about is that the range of fund managers will bounce back. So what we're sort of saying here is, more of the capital is going to get concentrated into sequel funds and concentrated to sort of fewer managers. And then, of course, we're also sort of seeing this concentration by asset class or by geography. You mentioned 50% of activity was concentrated in the top 5 cities. In terms of the second part of your kind of question on sort of types of funds, so what I'd sort of say to that is that core capital is dominant in each individual market. So Japanese in Japan, or as you mentioned, sort of Koreans in South Korea. And if for capital that is kind of regional in nature or even global, core plus is growing certainly in this region, but is still coming off a relatively low base. Accordingly, I sort of see the capital being deployed still into sort of value add funds and also some opportunistic funds. And then, of course, you get into the sort of sector specialism. Logistics, still mostly, I would suggest, about development. Data centers, which might actually be slightly private equity in nature, and then obviously kind of the emergence of some debt and credit activities. Some of these, quite a lot actually, are sort of coming through in the form of sort of clubs, JVs, and partnerships, rather than necessarily the commingled funds. Back to you, Catherine.
I see. Thank you, Gordon. The next question I see over here is regarding the impact of the new U.S. presidency, and I'll turn to Dennis on this one. Is there any major impact that you foresee that the new U.S. presidency will have on the APAC markets?
Yes, actually, from a Biden administration, I think one could see some unwinding of the Trump's tariff. But this would likely to be slow, and these tariffs would actually be handed down to the new administration as bargaining chips in negotiating for other priorities, such as the protection of intellectual property rights. There's likely to be less uncertainties related to the US trade policy, since it is expected that the Biden administration would seek a more multilateral and steady approach to negotiation. Nevertheless, I feel that the process of decoupling is actually already underway, and with some investments being directed away from China and towards the other APAC economies, and this is positive. This will benefit the Southeast Asian countries as well as India to a larger extent. So even in a time of uncertainty or transition, as we call it, countries with stable governance, good infrastructure, ample skilled labor, and a relatively low cost base, will attract further investments as they work to maintain a stable, friendly relationships with both China and the US.
I see. Thank you very much, Dennis. The next question I see is regarding joint ventures among international investors, which also relates to the first question that we had on fundraising. So, Gordon, what sectors and market do you see that these JV investors will be most interested in, and any specific trends you've seen how they would choose their strategic partners?
It's good to focus sort of on that, Catherine. I think clubs, JVs and partnerships, are really what has sustained us through sort of 2020. Obviously, direct sort of 100% bricks and mortar deals have been down significantly, but deployment has still been possible in region through the various formats I've just mentioned. In the logistics arena alone, we've probably tracked some sort of 70 plus instances in the last sort of 18 months. If you then add in the universe of data center groups forming various collaborations, and then sort of further overlay sectors like cold storage and self-storage, which obviously also sort of make use of industrial land, you just get an idea of how much activity there has been. We've just actually come off the back of an internal sort of APAC leadership event this week. We're joined by an external speaker from one of the leading logistics groups operating in this region. They were saying that they're currently in 9, soon to be 10 countries. And accordingly, you'll appreciate that this goes well beyond the usual suspects of countries and calls for a pretty varied approach as they react to their sort of customer demand. and tackle countries, like Vietnam, like Indonesia, as well, of course, of India and China. And then if you kind of look at the sort of 2 of the top 10 capital raising firms in APAC in the last 5 years, are logistics orientated, so sort of GLP and ESR. By country and by strategy, their approaches have kind of varied widely, taking in everything from REITs, commingled fund, club deals, specific JVs, those that are development focused initiatives, income or takeout focused initiatives, and so it goes on. So there is really kind of no one size, no one solution to sort of this. Second part of your question sort of asked about specific trends on partner selection. I reckon it's pretty difficult to pick out trends per se. Maybe it'd be good to get the audience to think and ideally send to me, if you'd be so kind, their responses to the following sort of questions or observations. Number one, I guess, kind of where and in what sectors do you need operational expertise? Secondly, an inclination towards creativity or sort of consistency. Creativity, I guess, in this sense is, encountering a group that, acknowledging you've not been able to visit an asset, not been able to visit a country during this COVID period, and yet, a group is out there that has been able to come to you with a well-rehearsed idea. Or do you crave kind of the consistency? They produce this in one country, so I'm confident that they'll produce it in another country, and I'll follow them to that country. And then finally, sort of, do you sort of gravitate to sort of specialism or the herd? And I spoke earlier, obviously, about the concentration, which I guess is a reference to the herd. Or do you sort of seek out a partner to deliver a solution on a sort of specialism? So have a think about those sort of 3. And if you've got thoughts, I'll be delighted to hear from you. And we'll see if we can formulate some trends off the back of that. Thank you, Catherine.
Thank you, Gordon. The next question I'd like to pick up here is on the Singapore market. So I'll ask this one to Dennis. What's your view on the increasing engagement between China and Singapore, as we recently saw both parties looking to expand investment and operations in each other? And how will the recent signing of RCEP change or improve the relationship between the 2 countries? And what does this also mean to the rest of the ASEAN countries?
Okay, well, Singapore active business and geopolitical engagement with China goes back some 50 years, right? I mean, in the early years, China had turned to Singapore for town planning, for roadmaps to urbanization, including development, for example, of Suzhou Industrial Park as one of the earliest industrial estate development modeled after Singapore's Jurong Town Corporation, JTC. Now that the Chinese companies are becoming giants and becoming multinational corporations, Singapore functions as a base for them to go international and overseas. But a few important factors come into play here for Singapore, right? You would know that Singapore use English as the main business language, and that language being the international business language, and the whole education program for the people of Singapore is so critical for this kind of partnership. Second is really about Singapore continual investments in our infrastructure, including airports, seaports, roads, rails, shipping lines, and more recently in technological infrastructure, including telecoms, 5G, fiber network, Singapore digitization plan, and the like. Right. Third, I think it's also very, very important that we have a very robust banking and financial system and governance to support businesses. Okay, and last but not least, I would say, making Singapore a place to work, live, and play, a place to be desired, of good food, entertainment, fun, sports, and safety and the security aspects, etc. Right? This kind of bring people here, set up business here, and when business are set up here, there's obviously demand for real estate. So when business desire to locate in Singapore, that's when all aspects, of the real estate click. The real estate, the property will continue then to be great investments, whether they're for the funds to invest in, for the investors to invest in, or for occupiers and users. As for the other Asian countries, they have something which Singapore doesn't have. So this is a separate strategy, right? And that really is population, the people, right? For example, Indonesia, 275 million. Vietnam, 97 million. Thailand, 70 million. Myanmar, 54 million. Philippines, 110 million. Malaysia, 33 million. And more importantly, combined, a rising middle income population. Okay, so, the signing of RCEP, which just happened literally last week, right? Would also mean that, countries cooperate in development of physical infrastructure, roads, rails, etc., including technology and digitization, the banking system, corporate governance, etc. And note that these are the areas where Singapore and China have excelled and could actively lead and participate in for the region, right? For the RCEP countries. And further, these investments will pave ways to increase jobs, raise standard of living, lift populations out of poverty, and improve the economies of ASEAN. It would probably take another 2 days actually for us to look at opportunities just in real estate. So I think I will stop here for now.
Thank you, Dennis. That was quite insightful. I also see a question on India, and I will ask this one to Gordon, as I know you've been involved in a few India projects recently. What's your view on the future growth of commercial property investment in India?
Thank you, Catherine. Yes, I've been spending a little bit more time on the market, but I will ultimately defer the question to our Indian colleagues and perhaps to sort of future webinars where we can focus on that sort of sector. You've got sort of 6.6% GDP growth per annum expected, I think, for 2021 to 2030. Accordingly, the office employment growth that aligns with that is also globally exceptional, say perhaps only for China. And then sort of even without, I guess, the noise from across the rest of the globe, there's plenty of growth via a focus on the domestic market. And that will give you the catalyst that you need for strong office net absorption and the flow into other sectors, obviously, as well. And I think reducing poverty, improving education, and active promotion of homegrown sort of companies. So India is kind of not immune to geopolitical risk. That said, the effects of it may be less impactful in India as compared to some of the other locations. You mentioned, or sort of up on the slide earlier, was the example of some of the groups taking large amounts of space here in Asia Pacific. I spotted that Accenture taking up 1 million square feet in Bangalore. Does the ongoing talent that's on offer in India keep multinational companies kind of actively engaged and growing their footprint in that market? Bit of a rhetorical question there. I believe the answer will be yes. Today, then, from the investor standpoint, looking in, they've got a much clearer route to eventual exit, with the establishment of a domestic REIT market. It's not going to be the solution in all instances, but of course, has added significant transparency to the market. If you combine this then with improving build quality, infrastructure, and then I guess a clearer understanding of the positioning of specific cities towards various industry sectors, and the emergence of clearer sort of growth corridors within those cities, we are of the opinion that's going to be fewer instances in the next 10 years of investors leaving India with a bad impression. I'm conscious that over the last 10 years there's been a few examples of that. Looking forward, I think far fewer examples of of people leaving the Indian investment market unsatisfied.
Thank you, Gordon. I see a couple questions on banks' lending attitude with the current situation. Would you like to pick on that?
Yeah, it looks like we've got a couple of questions in, one around search for opportunistic returns in sort of Japan and Korea, and a sort of question linked to that about sort of local sort of development finance available. Separate questions on the sort of the debt side. It's a little bit like how I've been responding to one or two of the other questions, you know, sort of a concentration. Tim can pick up more directly as it relates to the Japan market and sort of the opportunities in the logistics arena. I think he's even alluded to some of those already. But just sort of generally, obviously, we're seeing, I would sort of say, a smaller number of groups that are capable of accessing, you know, development in either of those markets. And then if you're coming at it with a strong sponsor, then, you know, construction finance or, you know, competitive finance is available. We're obviously still in a low interest rate sort of environment. But you know, the overriding kind of message is one of sort of concentration. Again, Catherine.
Thank you, Gordon. Before we get into more specific questions on Japan, I'd like to ask one more question on the emerging markets in Asia Pacific to Dennis. What's your suggestions to investors who are looking to make a move in the emerging markets, and which countries or property sectors do you foresee having the most growth potential?
Okay, I'll keep this quick and short. Countries, Vietnam and Philippines, this has a lot to do with the population not only being large, but also the English business language, young, well-educated, IT-savvy people, right? And you talk about sectors, I would say logistics and industrial as one, residential multifamily as the other, right? For the obvious reason of rising middle income, e-commerce, manufacturing, and supply chain. That's my answer.
Thank you, Dennis. That's very short and sweet. So I'll move on to more specific questions on the Japan market. Since Japan is the #1 investment destination by cross-border capital, what advantages do you see or you think it offers comparing to other gateway cities like New York and London? Tim, would you be able to help answer this question?
Sure, thanks very much. So I'd like to start by saying that typically transactions by foreign investors tend to make up roughly 1/5 of the transactions we see in Japan. But this year, year to date, we're pushing over 25%, closer to even 30. So we've definitely seen more from foreign players this year than in previous years. And well, I don't know if advantage over the other markets in perhaps EMEA and the US is necessarily the reason why the Japanese market is the #1 destination. I would say that now, more than ever, investors are looking for yield, and Japan is a fantastic market for that. So Japan offers some of the best, if not the best, yield gap in Asia, which allows investors to hit high cash-on-cash yields. And you know, I'd also like to say that, you know, it can be difficult to generate high capital gains in Japan, particularly at the moment. But the distribution yields are certainly very attractive. And Gordon touched on this a little bit earlier about opportunities for opportunistic returns in the development of industrial space in Japan. And certainly we do see those opportunities available. They are not as frequent as they might have once been, but those opportunities are available, and we are actively identifying them. And local development financing, you know, is available for these type of opportunities. And you know, as Gordon so rightly mentioned, it does matter who your sponsor is in getting the best terms for those.
Thank you, Tim. As you mentioned, the current financing cost in Japan or Tokyo is very low. And we have a question over here, and he's wondering, would there be any occasions where this low debt environment could shift suddenly in Japan? So do you foresee any sudden increase in the current low interest rates in Japan?
Yeah, very short answer, no.
No. Thank you. The next tougher question is on Japan's aging population. As we know, the value of real estate comes from people, and if Japan's population, especially the working age population, is likely to downsize, Tim, what do you think this could potentially mean for long-term growth in the Japan real estate market?
Thanks. Yeah, we get this question a lot, obviously, as it is a question that's on everyone's mind. And yeah, indeed, Japan's population growth did turn negative back in 2011. And that being said, it is counterintuitive, but despite the aging and shrinking population as a whole, cities such as Tokyo have continued to demonstrate modest population growth. And what we're seeing is that the major cities are growing, but at the expense of rural areas. And what this means is that investment for the long term is that attention does need to be paid to the growth trajectory and the competitiveness of the local cities. So you do need to be very careful when making your investments. But central Tokyo is a fairly safe bet.
I see. Thank you very much, Tim. And Gordon, I see a few questions coming up on my screen. Would you like to pick up on a few questions over here?
Yeah, if I may, just as much as I give Tim a moment's break from all these fantastic questions that he's getting on Tokyo. We've had something in on costs of construction. As a group, we have just putting out a report at the pan-regional level on costs of constructions. I think it was framed in the context of our cost of construction sort of changing in various markets. So sort of look out for that. We've also had questions in as it relates about a shift of occupiers from Hong Kong to other locations. Citing in particular Singapore, and I guess that might be reference to some of the China groups that have established presence in Singapore recently, or indeed to Tokyo, I guess reflective of this being a session more focused towards the Japan and sort of Tokyo markets. Again, kind of relatively recently, we produced a survey results, a sentiment survey results around asking Hong Kong companies, both international and domestic, as to their intentions going forward, and kind of the messaging from that was very little actually considering relocating out of Hong Kong. But just to sort of guide those that have asked those questions towards a couple of recent publications that we have done. So Catherine, back to you.
Thank you, Gordon. For time reasons, I'll ask one last question on the Japan market. As the focus of the presentation today is quite centered around the Tokyo market, what opportunities do you see in other Japanese cities besides Tokyo? Tim, would you be able to provide some advice to investors on this?
Sure, thank you. So, other markets, other than Tokyo would definitely include the Osaka area as well as Nagoya and Fukuoka. As a company, we see great opportunities in the Osaka area logistics at the moment, and we are very big believers in the space. As of September end, we have acquired a large site for development in the Osaka area. So again, we think that area is going to be perform very well. And I would say, as mentioned earlier, investors do need to be a bit careful when venturing too far out of the urban centers. So, central locations in some of these urban cities. So Osaka, the Umeda Station area, in Fukuoka, definitely want to stick in the Hakata Station area for the long term.
Thank you very much, Tim. And with that, I will pass the floor back to Anna for final closing. Over to you, Anna.
Thanks, Catherine, and thanks very much to Dennis, Tim and Gordon for that panel and all the questions that came in. I think, there were some really interesting questions there, a few of which we might come back to some of you, and we didn't get through them all. But I think for me, the takeaways around what's been happening in Asia Pacific capital markets in Q3 and to date over this year, there are a couple. I think, as Gordon said it, liquidity is good, but it's becoming increasingly concentrated. I really like Catherine's 3 key trends that we're seeing in terms of, capital activity and transactions: a flight to safety, a flight to quality, and a flight to necessity. I think both Dennis and Catherine, pointed to the increasing volumes that are being traded in industrial and data centre sectors, as well as multifamily, and this is in both advanced and emerging markets across the region. And Gordon also pointed to increased interest in cold and self-storage. I think we heard Japan, China and Australia continue to be the biggest attractors of capital, or global capital, I should say, in our region. And of course, we've seen that flurry of transaction volume in North Asian markets. Catherine also, had that great table there for, I guess, some thoughts around where to look and where to focus if you're looking for core or core plus to add value or opportunistic acquisitions. So you've got her recommendations, or our recommendations, in your back pocket to draw on. And then I guess, with a focus on Japan, Tim sort of spoke to some of the key attractors of the Japanese commercial markets, the strong underlying property market fundamentals. Tokyo's clearly been winning the rental growth race and the absorption race recently. And, good to hear after the year that was 2020 and all the challenges, those positive economic signs coming out with, GDP growth outperforming expectations this quarter. Of course, we've got the positive news on the global vaccines that continues to gather pace, and really pointing to investor appetite not waning in Japan, particularly in the residential and logistics space. Deals are still being done. I think Tim said that transactions were only 19% down on 2019 figures this year, and there's still a lot of increase, as we heard, from that global capital, international capital looking for great yields, and Tokyo offering one of the highest yield gaps in the region. I think, last but not least, Tim did caution us that after being a landlord market for a number of years, there are some headwinds, facing the major office markets, particularly Tokyo, and we're forecasting that those record low vacancy levels are going to double over the next 3 years, which of course will put downward pressure on rents, but still lots of opportunistic investment, opportunities, again, especially in industrial. And I think I heard we don't need to be too worried about the negative population growth. Central Tokyo is a fairly safe bet. Osaka looks good too, but maybe be a little bit more careful on some of those regional cities in the context of employment growth and absorption and demand. So great webinar. We did hear a shout out from Gordon on the CapEx guide, the cost of construction that our projects team is putting out on Asia Pacific. Keep an eye out for that. As I mentioned at the top of the call, we have 2 global investment reports coming out on the industrial sector and the multifamily sector. And we're also putting out a piece imminently on the future of work and the future of office. So if that's all too much to remember, just keep an eye on our website, cushmanandwakefield.com, but we'll endeavour to get those reports out to you, and very much look forward to having you all to our next capital markets webinar series across Asia Pacific. But with that, we're right on time. So again, thank you to Catherine, to Tim, to Dennis and to Gordon, and thanks everybody for attending. Good afternoon.